Continuing our look at interest rates, Chapter 4 covers the Federal Reserve System and how monetary policy influences interest rates. The Federal Reserve was founded in 1913 as the independent central bank of the United States. Central banks determine and control the monetary policy of their home countries. While subject to congressional oversight, its decisions do not have to be ratified by the President or by Congress. The Federal Reserve is governed by a 7-member board domiciled in Washington, D.C. Members are appointed by the President and confirmed by the Senate. Terms are for 14 years, are non-renewable. The chairman of the Fed is appointed by the President and confirmed by the Senate for a 4-year term. The Fed board decides on and conducts monetary policy as well as supervising and regulating banks. The Wall Street Reform and Consumer Protection Act of 2010, also known as Dodd-Frank, required the Fed to supervise to mitigate systemic risk to the financial system. This act gave the Fed and other agencies much broader powers to take action to reduce systemic risk. The Federal Reserve is responsible for implementing, not making, laws to protect consumers' financial transactions. Protecting consumers can take several forms: ensuring compliance with regulations, investigating complaints, making sure underserved groups have access to services. The Federal Reserve is organized into 12 districts, each with a main Federal Reserve Bank and sometimes branch banks in other cities in the district. For example, Memphis is in the St. Louis Federal Reserve District, but there's a branch Federal Reserve Bank in Memphis. Federal Reserve banks are supervised by the Fed Board. The controller of the currency charters national banks, which are required to be members of the Federal Reserve System. Member banks own the 12 main Federal Reserve banks, which serve as depository institutions for the banks in their district. This map shows the 12 Federal Reserve districts. Memphis is in the St. Louis district, though as mentioned, there is a Federal Reserve Bank in downtown Memphis. While nationally chartered banks are required to be members, in other words, buy stock, in the Federal Reserve System, state chartered banks may choose to do so if they meet the criteria. The main benefit of membership is direct access to the Fed Funds wire transfer network in interbank borrowing and lending of reserves. The most important and most widely known part of the Fed system is the Federal Open Market Committee, the FOMC. The FOMC is the major monetary policymaking body of the Fed. The FOMC has 12 members, 7 members from the Board of Governors, the President of the New York Federal Reserve Bank, the reason will become obvious, and the presidents from 4 of the other Federal Reserve banks on a rotating basis. The FOMC policies seek to promote full employment, economic growth, price stability, and a sustainable pattern of international trade. These 4 goals can conflict with each other, complicating the role of the FOMC. The FOMC seeks to implement monetary policy to achieve these goals via the open market, hence the committee name. Their main tool is to impact interest rates. There will be trade-offs between these goals. The Fed must balance expansive monetary policy that tends to generate growth and higher employment against inflationary pressures in the economy. When unemployment is high, the Fed's attempt to stimulate the economy to generate additional jobs may result in inflation. There are also trade-offs in the U.S. monetary policy and the value of the dollar. A stimulative U.S. policy may cause the dollar to drop, particularly if U.S. growth remains slow. If the Fed keeps U.S. inflation below the rest of the world, then the U.S. dollar will tend to strengthen, all else equal. And with a strong dollar, U.S. imports are likely to exceed exports, leading to a trade deficit. The FOMC sets a target for the Fed funds rate. It does not set the rate. The FOMC directs open market trading to achieve the target. Open market means the Fed directs the Federal Reserve Bank of New York to buy or sell government and agency securities to guide the Fed funds rate to the target. This is why the president of the New York Fed is a permanent member of the FOMC. The FOMC does set the discount rate, though it must be approved by the Board of Governors. The discount rate is the rate charged to member banks for loans through the discount window to Federal Reserve Bank members. Banks are required to have a certain percentage of reserves on deposit at the Fed every day. If at the close of day a bank is short, they can borrow funds through the discount window. The loans through the so-called discount window involve the discounting of short-term securities in exchange for cash loans. The rate charged is the discount rate. The Fed also supervises member banks, conducting examinations, issuing warnings, and approving mergers. Basically, the Fed acts as the commercial bank for the U.S. Treasury. Federal Reserve banks issue and replace currency. They act as the central clearing system for U.S. banks, clearing 25% of all checks. The FedWire facilitates trading of bank reserves. The Fed ACH processes debit and credit transactions and direct deposits and direct bill paying functions. The ACH now processes cross-border payments and has recently begun offering same-day clearing of certain checks converted to electronic images. The Clearinghouse Interbank Payment System, CHIPS, provides yet another payment mechanism. CHIPS is a private sector electronic network operated by about 100 U.S. and foreign banks to facilitate correspondent services and international transactions. It's usually used in conjunction with the Society for Worldwide Interbank Financial Telecommunication, SWIFT, an international messaging system that sends instructions for payment terms. Authorization through SWIFT before money is moved via CHIPS provides a safeguard. Federal Reserve banks also engage in a significant amount of economic research related to monetary policy. Like any bank, the Federal Reserve has a balance sheet. The major liabilities include reserve deposits and currency, major assets, Treasury and government agency securities. In implementing monetary policy, the Fed has two options: target the level of reserves or target the Fed funds rate. Since the early 1990s, the Fed has primarily used the Fed funds rate. The Fed funds rate, as defined, is the rates banks charge each other for overnight loans to meet reserve requirements. The rate serves as the basis for all other short-term loans. The Fed funds target range as of 7/11/2020 is 0 to 0.25%. The FOMC directs the trading desk at the New York Fed to buy or sell government securities to move the rate toward the target range. While the FOMC sets a target for the Fed funds rate, it sets the discount rate, the rate that the Fed itself charges on loans to member banks through the discount window. Rarely used as a policy tool, discount rate changes are viewed as very strong signals of Fed intentions. Typically, the discount rate is greater than the Fed funds rate. This chart illustrates the monetary implementation process we'll be discussing in the rest of the chapter. Regardless of the tool the Fed uses, it seeks to influence the market for bank reserves. Bank reserves are the required and excess reserves held as depository institution reserve balances in accounts at the Federal Reserve banks, plus the cash on hand at commercial banks. Specifically, the Fed is trying to influence the supply and demand for excess reserves and, in turn, the level of interest rates. The Financial Services Regulatory Relief Act of 2006 authorized the Fed to pay interest on reserve balances. The Fed can take two approaches to affecting the market for banks' excess reserves: target the quantity of reserves required or target the interest rate on those reserves. Back to the FOMC and open market operations. When the FOMC announces a Fed funds target rate, it is forwarded to the trading desk at the New York Fed. The trading desk buys or sells U.S. Treasuries over the counter to move the rate within the target range. Acting through the New York Fed, the trading desk typically buys or sells Treasury bills. These operations may be short-term or permanent and can use repo agreements. This chart outlines the FOMC process of implementing monetary policy. The FOMC sets the discount rate, sets a target range for the Fed funds rate, and may change reserve requirements. The targets are the level of bank reserves and interest rates via the Fed funds rate. This can force a variety of changes in financial markets: bank reserves, money supply, interest rates, security prices, foreign exchange rates. All of this is focused on the fundamental objectives of the Federal Reserve. So how does it work? Suppose the FOMC wants an expansionary policy, so they want lower interest rates. To lower interest rates, they increase the supply of funds in the market by buying securities from member banks. Buying securities puts money in the bank's balance sheets, giving them more funds to loan at the lower rates. Contractionary policy would be the opposite. The FOMC wants higher interest rates, so they sell securities to member banks. This removes funds from the bank's balance sheets and lowers reserves. Less funds available, interest rates go up. Looking at the two monetary tools, targeting the money supply or the interest rate, they can only target one, as that will spontaneously affect the other. Targeting the money supply, MD is the demand curve for money, and I* is the current interest rate. Assuming supply stays constant, if demand goes up to MD prime, then the interest rate rises. If demand declines to M double quote, then interest rates will decline. In panel D, the Fed targets interest rates. The current rate is 6%. If the demand for money decreases, then the market rate will decline to 5%. To keep the market rate at their target of 6, the FOMC must use open market operations to shift the supply. They would do this by selling securities, which would bring the rate back to the target of 6%. Looking at each of the charts on the previous slide separately. Targeting the money supply. Current interest rate 6%. If demand increases, then the interest rate shifts up to 8%. If it declines, it shifts down. Looking at the other chart, targeting the interest rate. Currently 6%. If demand declines, then the rate declines. To maintain the rate, the Fed has to lower the money supply, and the Fed can only target one. The other one moves on its own. As the slide states, reserve requirements are the reserve assets depository institutions are required to keep to back up transactions. How it works. This is the so-called multiplier effect. The formula is shown on this slide, and we'll walk through an example. If the Fed reduces the reserve requirement percentage, then depository institution can hold fewer reserves and able to lend out a greater percentage of their deposits, thus increasing credit availability in the economy. New loans finance consumption and investment, and some of these funds will return to the depository institution as new deposits, leading to more loans, and so on and so on. That's the multiplier effect. So suppose reserves are currently $2 billion. The Fed increases reserves by 1%, or by $20 million. The predicted increase in bank deposits is, using the formula, $200 million. Suppose instead the Fed reduces the reserve requirement to 9%. This generates a new level of excess reserve funds of $20 billion, so the increase in bank deposits should be $222 million. The effectiveness of monetary policy changes depends on a variety of market and investor reactions. First, there can be a significant time lag between implementation and effect. Making more money available doesn't mean banks will lend it. Lower interest rates or increasing the supply of money may not work. Consumer confidence may be so low that investors may still hold back. If unemployment is high and debt levels are high again, policy changes may result in very little effect. Additionally, more money may cause a decline in the value of the dollar, resulting in inflation. Inflation may cause interest rates to rise, further affecting growth. And finally, foreign investors may lose confidence, again hurting growth. The Fed does have responsibility for foreign exchange as well as domestic monetary issues. Generally, the Fed allows exchange rates to float freely. Other countries, however, do intervene using actions similar to our open market activities to manage the exchange rate on their currency. Major central banks around the world responded to the financial crisis in 2007 in a variety of ways. Many expanded their retail deposit insurance, direct injections of capital to improve the lender's balance sheet, debt guarantees, asset purchases, stress tests. The 2007 crisis, though 13 years ago, gives an interesting view of how the Fed and other central banks reacted to a financial crisis. Declining home prices resulted in many homeowners being underwater on their mortgages, owing more than the home was worth. With the decline in home values, the value of mortgages and mortgage-backed securities declined as well. Much has been written about the impact of subprime loans on the crisis, loans to those without the required level of credit to qualify for their home loans. Banks were reluctant to commit to any long-term loans. The London interbank offer rate rose overnight. Moving into 2008, the Fed facilitated J.P. Morgan's purchase of Bear Stearns. The Fed created the Term Securities Lending Facility and the Primary Dealer Credit Facility, both aimed at backstopping the problems in the financial sector. By fall 2008, much had changed with some old names in the financial sector gone. Lehman Brothers filed for Chapter 11. Goldman Sachs and Morgan Stanley became commercial banks. Merrill Lynch is bought by Bank of America. The AMLF and the CPFF, Asset-Backed Commercial Paper Money Market Mutual Fund Liquidity Facility, and the Commercial Paper Funding Facility, were created because liquidity collapsed in the commercial paper market. The MMIFF was created to help stem liquidity problems in money market mutual funds that resulted when one fund failed. The term asset-backed securities loan facility was designed to encourage securitization to continue, because slowdowns in securitization had reduced the amount of credit available to borrowers in certain markets. All of these facilities were implemented to stem the fallout in the financial market. Overall impact of the crisis can be encapsulated by the growth in average weekly lending from the Fed, from $59 million per week in 2006 to $850 billion in 2008. In August 2006, the Fed funds target rate was 5.25. By April 2008, it had been reduced to 2. By the end of 2008, the target was 0.25%, exactly where it is right now. November 2008 saw the first quantitative easing, purchasing treasuries and mortgage-backed securities to push money into the economy. November 2010, QE2, bond buying. September 2012, QE3, monthly purchases of treasuries and mortgage-backed securities. And that ends Chapter 4.